Hey guys, welcome back to the Bumpy Road to $10 million. If you're in your 20s or 30s and are thinking about how to grow your money in the stock market, this series is for you. As a reminder, this video is not financial advice. You should always do your own research before investing. Also, if you haven't seen the first 4 videos of this series, I highly encourage you to do so, as each video in this series is a building block. And if you found these videos helpful so far, please hit like and subscribe below. It will really help spread the word. Now we're going to start by showing you why we have put options in the portfolio and what actually happens in the worst case scenario. This is such an important topic that it will be the focus of this entire video. As a reminder from our overview of put options in video 3, put options obtain their maximum value when the underlying stock price goes to zero, and this maximum value depends on the strike price. For example, if I have one put option contract for 100 shares on any stock and the strike price of the option is $10, then if the stock price goes to zero, my profit would be calculated by multiplying the strike price of $10 by 100 shares. So in this example, my profit would be $1,000. Now let's apply this to our portfolio based on the initial allocation we discussed at the end of the last video. As a reminder, the portfolio value is just under $10,000. And specifically, we had 51 shares of UPRO and 25 shares of SPXL with a combined value of around $9,600. This is just a sum of $4,845 for UPRO and $4,750 for SPXL. We also had one put option contract each on UPRO and SPXL with a combined value of $360, which is the sum of $160 for the UPRO option and $200 for the SPXL option. Now, let's say some unprecedented event occurs and the UPRO and SPXL prices drop from $95 and $190 each to zero overnight. If we don't have put options in place, we're obviously screwed. Our $10,000 investment goes to zero overnight. But we do have put options in our portfolio. And because of this, in the worst case scenario, our portfolio value will not be zero. In fact, it's going to be much higher at $7,000. This is because the put options would increase in value from $360 to a combined value of $7,000 for a return of close to 2,000%. Now that sounds crazy. How does it work? Remember, we have one put option contract with a strike price of 25. This means that if the UPRO stock price declines to zero, the value of the UPRO options would be calculated as 25 times 100 or $2,500. Similarly, we have one SPXL put option contract with a strike price of $45. So if SPXL stock declines to zero, we would get 45 times 100, which is $4,500. So the total amount we would receive is $7,000, and instead of 100% loss, our loss would be capped at 30%. And remember, this is if something unprecedented happens and both UPRO and SPXL stock prices decline to zero overnight. So the way I see it, the worst case scenario for this portfolio is actually not that bad. Now, all that might sound great, but it's important for you to know what we just covered is a theoretical outcome. And I say this because in 2 decades of investing, I have never actually been in a situation where the underlying ETF I have held has literally gone to zero while I had held put options on the same ETF. As Nassim Taleb very eloquently said, in theory, there is no difference between theory and practice, but in practice, there could be a big difference between theory and practice. So in our example, in the worst case scenario, would we actually get the $7,000? Or is it just theoretical, wishful thinking? To get to the bottom of this very important question, I did a lot of research and also asked several senior people in the investment management industry, including hedge fund founders. What would actually happen in this scenario? And my personal conclusion is yes, if the stock prices of UPRO and SPXL truly go to zero, we would get the $7,000. And actually, the mechanics behind receiving this money is even easier than you think. Our options would automatically be cash settled, meaning we would receive the $7,000 cash in our brokerage account without having to do anything. And this is a pretty great outcome. But again, it would be unethical of me to say that we will absolutely 100% receive the $7,000 in the worst case scenario because I have actually never been in the situation. However, my research indicates it will almost certainly be the case. As always, I encourage you to go out and do your own research to verify this, and if you come up with a different conclusion, please let me know in the comments below. Now, say the ETF stock prices drop to $1 instead of zero. In this case, we wouldn't automatically receive anything from our put options, as this is actually quite different from the stock prices truly going to zero. Here, we would have to either exercise our put options, and the profit would be the strike price minus the stock price of 1 times 100. The other and probably better option would be to sell our put options through our brokerage platform, just like we would any stock, for a significant profit. But I don't want to digress too much here. The main point I wanted to get across is in the worst case scenario, where the stock prices of UPRO and SPXL decline to zero, the overall portfolio is fairly well protected by the put options. Now, do we hope the stock prices decline to zero so our put options can obtain their maximum value? Absolutely not. We only buy put options in the portfolio for insurance. We hope we never have to use them, and we hope the drivers of our portfolio profits will be UPRO and SPXL, not the put options. But in a worst case scenario for UPRO and SPXL, we would be very glad we have the put options in our portfolio, as they would significantly reduce the portfolio losses, as we just saw. So that's it, guys. We now have a portfolio with a value of around $10,000. This portfolio has a lot of upside potential if the S&P 500 increases in value as expected, and also has significant downside protection if some unforeseeable disaster occurs and the ETFs we own go to zero. At this point, you should not only understand what we own in the portfolio on day one, so UPRO, SPXL, and the put options, but more importantly, why we own these securities. Now, after we've made the initial investment, whether it's $1,000 or $10,000, a reminder that a key component of this strategy is to regularly invest $1,000 every 2 months after the initial investment date. So we will next discuss how exactly to allocate additional capital every 2 months. We will also talk about how to rebalance the portfolio towards the end of every year when the put options are about to expire, and a lot more. If this was interesting and helpful, please don't forget to like and subscribe. As always, thanks for your time, and I look forward to seeing you on the next one.